Welcome out to the Blue Sky Trading Lab. This is Coach Matt, guys. We're going to be talking about volume here today, and we're going to start working on not just what is volume, but kind of what expectations for volume based on technical patterns is, and how to use volume to help us in terms of confirming our decisions to get into a trade, when a trade's coming to exhaustion, that type of stuff. We're going to jump into it right in 1 second from now. When we have these conversations, when we're doing kind of the definitional stuff, this is going to be a little bit of a review for a lot of you that have a lot of experience in the market. You understand exactly what you're doing from a tradable situation. But in general, what I have found is, even as an educator, is even if people have a deep understanding of something, it's always good to review it, number one. And number two, you might learn a little tidbit here or there as well. But I always like to lay a really detailed foundation from an educational perspective for a couple reasons. Number one, so that the new traders get brought up to speed, because I think that is, when you're in a community, I think it's important to raise all the ships. Would you guys agree with that, by the way? That when you're in a community and you're teaching these concepts, that from my perspective, it's important to try to teach to everybody. And I assume when we first have these conversations that nobody knows anything about volume. And as we get more people to understand the basic nature of it, we can start having deeper, more compelling conversations down the road a little bit. Now, as we go through the presentation here today, and I did design this nice little presentation for you guys, but as we go through the presentation today, if you have any questions, obviously pipe up, ask away. We're here to learn, communicate, and get better as a community. So with that said, let's talk a little bit about what volume is. Volume is a simple measurement of participation. That is what volume is. You never really have more buying volume than selling volume. You never really have buyer's volume versus bearish volume. Volume is a measurement of participation, period, end of sentence. It's not directional. It has no directional context to it without assessing it through a pattern development perspective from a market perspective. But in general, when you see these green bars on your volume chart, or where you see those red bars on your volume chart, those are not buying volume versus selling volume. It's not bullish volume versus bearish volume. It's simply a measurement of participation. And the reason that's the case is when you deal with volume and trading in general, if I put an order in to buy something today, what does somebody have to do on the opposite end of the transaction? They have to sell it. And so it's a measurement of participation. But that measurement of participation can be extremely telling when it comes to where we think the market's going to go from here, where from a bullish perspective or a bearish perspective. But that's technical analysis. That's not volume. Volume is a simple measurement of participation, period, end of sentence. It is not bigger than that. Now, why does it matter though? Why do we track volume? Well, first and foremost, it tells us if there is conviction behind a move. That's number one. So if we see the market break out here, and the market's breaking out of this key level of resistance, and I took this screenshot from earlier today, guys. So the market's was testing this resistance. Here's the cash open right here. You see the market kind of consolidate for a little bit of time. As the market is consolidating right underneath the breakout channel, we start to see increases in volume. As the market is breaking out of resistance, we still see those increases in volume. That's what you want to see when you see a breakout in the marketplace. You want to see an increase in participation, because that increase in participation tells us there is conviction behind the price movement. It's not just some algorithm move out there, but there's something behind the algorithm move. Remember, there's always algorithms in the market. There's no doubt about that. But algorithms themselves don't create these massive spikes in volume. what creates massive spikes in volume is the additional participation behind the algorithms, meaning you, me, Mike, Steve, Riz, everybody, all of us in the collective market itself, they are what creates that volume. And so it's that measurement of participation. And when we see those spikes in volume at key levels, when key levels are broken, where we know there's battles there, well, that shows us, well, the bulls won the battle. You had a battle going on here right at a key level of resistance. Market broke out on an increase in participation. That shows you that there was a battle, that the bulls and the bears were fighting. There's a battle ensuing, and the bulls won the battle. And when the bulls win the battle, what do the bears have to do? They have to retreat. And so when you see those spikes in volume, it's not just buyers creating this massive spike, ladies and gentlemen. There's a battle for that level of support and resistance. Once it gets above it, you know the bears are going to retreat. And so those bulls are going to push the edge. The bears are going to retreat. As the bears retreat, they create additional volume because as bears retreat, they have to buy back their position to close it. We all know how that works. And it creates that momentum condition. And so why does it matter is because it gives us an understanding of those battles that are happening in the market. It gives us an understanding of who is winning those battles in the market and who's going to push their edge versus who is going to retreat. And so when you see strong price moves without volume behind it, your spidey senses get up. When you're navigating a breakout and the market's breaking out, but there's very little participation on the breakout, well, you got to be a little conservative there. You got to be a little cautious there because there's no strength behind the move. Whereas if you have a breakout with participation, you have conviction behind that move. You have an army of other traders looking at that same thing you're looking at saying, yep, we're breaking out of resistance. We have a whole bunch of army of bulls pushing the edge out there. They won that battle at that key level of resistance. And what did we see throughout the rest of the day, guys? Throughout the rest of the day, we saw that market just go up, 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 up throughout the entire rest of the day. And so when you're looking at volume, once again, why it matters is it helps us understand how aggressive we want to be when we're trading a breakout, or how aggressive we want to be when we're tracking a pullback, or how aggressive we want to be at a certain level in a certain strategy, because volume shows us that there's participation. Your money, and I know this is something that we all have to understand, but only Mike's money moves the market. Your money, my money, all of ours collectively, guys, we don't move the market. We are, the market is so big, so big, so big. If we only understood how much money flows through the financial markets every single day, $200 billion in equity value flows through the market every single day. $600 billion in equity value moves the bond market every single day. $5.7 trillion in total currency value moves the currency market every single day. These are massive, massive markets that are bigger than you would ever even comprehend. To get that market to move, you need strength behind it. You need participation, or you need Mike to trigger on a breakout. One of those two things. We need the entire market to trigger, or we need Mike to trigger. But one way or the other, we're going to see Mike's move in the market through that volume, through that increasing in volume. That's why it's important, because it gives you confirmation on everything you're doing from a technical perspective. It gives you affirmation on your technical read. When you say that market's going up, but there's nobody behind the move, I'm going to say I don't agree with you. When you say the market's going to go up and there's participation behind the move, I'm going to say, yeah, most likely I agree with that. And so when you see increasing in volume, that's increasing participation. When you see decreasing volume, that is low participation, indecision, chop, a lot of traps, guys. You want to talk about fake outs in the market? The majority of fake outs in the market don't have increasing volume. They have decreasing, they have a spike on the breakout and then it immediately comes back down. And so volume can help us confirm technical patterns. Volume can help us confirm when those technical patterns are not breaking out. That's why volume is important. Another reason why volume is really important, ladies and gentlemen, is not necessarily in when you're trading futures. What's the number one day tradable instrument for everybody here? What's the number one instrument you focus on more than anything? I want to hear everybody's answer. Give me one asset class you focus on every single day, regardless of the market. You are laser focused on that. I would say for the most part in BluSky, it's ES or it's NQ. I would say that's probably, I wouldn't say for everyone, Taryn, not everyone. A lot of people trade the ES. They just don't talk about it as much because the Mike and a lot of other people will trade the NQ. But when I'm holding court, we're talking ES because I trade the ES. And so I personally love trading the ES. I find the ES to be more consistent than the NQ. I find when the NQ's rocking, I'm sitting on a beach trading the ES while people are freaking out about the volatility. I'm laid back, just kind of hanging out, just capturing the move. And so I love the ES because the ES it moves in the same direction. It just doesn't move as fast as the NQ. And so it's not a beginner versus advanced situation, Bond. I can tell you that. I know some of the greatest traders in the history of mankind, and they trade the ES. And so it's not just a beginner versus an advanced situation, not at all. It is do you love volatility or do you love consistency? That's the difference. And if you are a beginner, yes, I agree with you. I'm not disagreeing with you, trader, on that. If you are a beginner, I would not start with the NQ. Not a chance in the world. It's fast, and it's a great tradable instrument for that, for people that love that type of speed. The ES is a little bit less volatile because it has the defensive names in it. You know what I mean? It's got staples in it, and it's got energy in it, and and one of the reasons I like ES is because it has those cyclical components. I rather enjoy trading the cyclical side of the market as well. And so, but I would agree with you. You and I are on the same page there. Okay. You start with the ES. Well, honestly, you start with the spiders, you graduate into the ES, and then you have an advanced program in the NQ. That's kind of how it works typically. But can we all agree that whether you're trading the ES or the NQ, like they're extremely liquid tradable asset classes? Like either one of them, you can get in and out because that's what this participation is all about, guys. Getting in and out. I want you can, and here's the rule of thumb. If you make a decision to get into any trade, even if there's zero volume, can you still get into that trade? Yes or no? Yes. You can be the first. Why can't you be the first? Of course you can be the first. But should you be the first? You can always get in. Now here's the different question. Can you get out? That's the question, trade Bond. You can get into anything, guys. You can get into anything. Doesn't mean you can get out. And that's really, you want it, Boba. Rule of thumb, you never want to be first in the market. Okay. Has anybody ever went cliff jumping before, like jumping off cliffs, like 30, 40 feet in the air and you're jumping into the water? Has anybody ever done that before? Are you ever the first one to jump, or do you have your buddy jump first to make sure it's safe? Like, I don't know about you guys, but if there's going to be rocks and there's going to be death and mayhem, I'd rather have my buddy than me. I don't want to be the first. I don't want to be the first fool, right? I want to make sure it's safe out there. So I think that's a rule of thumb in all aspects of the market, that you want to see somebody go first. You don't want to be first. You don't want to be last time thing. What I'm talking about in terms of getting in versus getting out is the whole conversation when it comes to liquidity. It's not as important in the futures market because there's constant liquidity in the futures market. It's a more important conversation when you trade equity or when you trade options. For example, liquidity and the amount of participation in the market will go to the tightness of the bid-ask spread. When you get into an option transaction, most of the time you're getting filled into the mid price of the option. And so, for example, the bid is the highest price somebody has offered to buy that asset at. The ask is the lowest price somebody has in order to sell that asset at. And so when you put in an order to buy at, say, 375, you're going to get filled at 375, and that bid will now move to 375. Or you can put in a bid at 365 and sit there and look at the order and not get filled. See, the algorithm in the market is programmed to fill in the mid price or as close to the mid price as you can. And so the tighter that the bid-ask spread is, the easier you're going to get into a trade, specifically in the options market. So what you're seeing here, guys, is you're seeing two different option chains in the options market. One is liquid, the other one is not. Both of them are $500 companies. Both of them are highly popular trading companies. But one of them you would never trade an option on. The left-hand side over here, for example, if you wanted to get into a transaction, the at the money strike has a bid of 55 cents and an ask of $1.05. If I wanted to get into this transaction, I'm going to have to pay $2.50 just to get into the mid price, because you're going to get filled in the mid price. Whereas if I'm trading this option over here, you see the bid at 210. The ask is 212. If I wanted to get into a trade, I can get into a trade in less than one fraction of 1 second at 211. The difference between getting in and getting out is everything. You would never in a million years trade this option chain, not because it has anything to do with the stock, not because it has anything to do with the expiration date, not because it has anything to do with anything other than volume. It simply does not have the participation for you to confidently make a decision to get into a transaction and, most importantly, get out of that transaction. And so when you're trading in the futures market, gold, oil, the indexes themselves, ES, RTY, YM, NQ, they are all extremely liquid, guys. You're not going to have a problem getting in and out of those asset classes. Hedge funds trade those, institutions trade those, you and I trade those, everybody trades those. But that's not everything in the market. And as you expand your horizon outside of just futures into equity and equity options, all of a sudden this conversation of volume and liquidity becomes vastly, vastly more important, because you have to take that into account, especially if you're going to ever trade options. If you ever see a zero bid, you are never trading that. But the identification here is the difference between the bid and the ask. Options, if you're trading over a $5, $10 spread on the bid ask, you're dealing with an illiquid option contract. Like, for example, 0 to 25 cents, 0 to 20 cents, 0 to 125. There's no logic to the option chain because there's no demand on the option chain. And if there's no demand, you shouldn't be the one to create that demand, not in the world of options. Because once again, the rule is you can get into anything. That doesn't mean you can get out. And if you bought a call option on this stock, you are not getting out of that trade. It is not happening. And the reason we buy options is to sell them at a later date to somebody else. And so you always want to get out. We want to trade liquidity, and volume is that sign of liquidity. I want to talk a little bit about the institutional volume and why it's important. Institutions, the reason it's important, guys, is institutions are different than us. Can we all agree with that? That the way you and I navigate the financial world is different than the way institutions make their decisions in the financial world. For example, you and I might buy something today with the intention of selling it today. Will a financial institution do that? They won't. They never do, guys. Hedge funds will, but hedge funds are not financial institutions. Hedge funds are kind of like the steroid version of the retail side. I'm talking about the banks, the institutions, the Wall Street institutions, the central banks, for example. When the Bank of Japan prints money to buy S&P 500 ETFs, they're not doing it to day trade, guys. When the Bank of Europe, the ECB, buys index funds, they're not doing it to swing trade. They're doing it to park money. The reason it's the case, and take it outside of that. If Warren Buffett decides to sell one of his companies today, can he sell his ownership in one transaction? I want to see if you guys know that. Can Warren Buffett sell all of his Coca-Cola in one transaction? The answer is no. And the answer is no because there's not enough demand on the other side of the equation. See, you and I, we can get in and out every single second of every single day. Institutions and the big boys and gals on Wall Street, like the Buffetts of the world, they can't. Bond, you're absolutely right. They have to break it up. And they have to break it up because they have so much. They can't liquidate all of their position in one fell swoop. By the way, that's one of the biggest advantages that you and I have against Wall Street is we don't have to break things up. We can get in and out as much as we want in a very quick time frame. But it's important to understand the institutional side of the equation because when an institution decides to leave a footprint, they're leaving a big one the size of, oh man, what's I was thinking the Loch Ness monster, but I'm thinking the oh, what's that one thing? I cannot believe I'm forgetting that name of that one. Bigfoot. Thank you. Thank you, Think and Grow Rich. Yes, they're leaving a footprint the size of Bigfoot. See, if I would have said that the first time, it would have worked out a little bit better, but then y'all get the point anyways. It leaves a footprint for us to see. And when they first start doing it, guys, they're going to do more of it. Because once an institution has decided to start the accumulation process, it's not in one moment in time. When an institution starts the distribution process, it's not in one singular moment in time. And so volume can be that measurement that we can see in the marketplace to help us understand when those institutions, the big dogs of the world, when they're getting in and when they're getting out. So let's call the big dogs the elephants, okay? They're the elephants of the market. They're the big dogs of the world. They have the most money. They can push asset prices. Think about Jamie Dimon at JP Morgan. Think about Larry Fink at BlackRock. Think about Goldman Sachs. Think about the central banks. They're the jungle. Then the elephants of the jungle are those funds, the institutions, the big dogs out there, the pension funds, the mutual funds, things that don't get in and out on a one day in, day out basis. They're the elephants. And for the elephants, guys, buying is a process. It takes time. And because it takes time, we can see it and its impact on the price over time as well. The retail side, think about them as the flies of the market. Now, I will say we're all retail. I don't think of myself as a fly. I just use the analogy because of an elephant. The flies are the point of the flies is to the market and to the elephant, we don't matter. Does that make sense, guys? I disagree with that, by the way. I think that's changing. But historically, that's how the elephants think about us is they don't even care about our volume. Do you think JP Morgan and Jamie Dimon has a conversation today about retail volume? Or do you think Larry Fink, who's the biggest elephant of the bunch, has a conversation today about retail volume? Probably not. Now that's changing over time, but we don't get our volume doesn't really show to the same levels as the institutional volume. Now, for most retail traders, guys, buying isn't a process, it's an event. And I want you to think about that for a second. When you went to make a buying decision today, did you have an emotional moment on any trade today? Who here had any emotion for any trade today? Why don't you think about it? Okay. I do too. I think it's normal. Now, why is it emotional? Well, think about it like this, Gabber. If the buying process is treated as a quote unquote process, should you have any emotion? If you're thinking about it as allocation over time. No, it's a process. You're not going to get emotional about that allocation over time. But when you put everything into that one trade, and that one trade is the end all be all trade, you're going to have a little bit of an emotion there. It's an event. The retail side of the equation sees trading as an event, whereas the Wall Street side of the equation sees it as a process. It's part of their job, it's part of the process. And when we see that process play out over time, there's a trending environment that happens there. Let me catch up on some of these comments very quickly. Um, Boba, no, I don't think the institutions are trying to leave clues on purpose, like they're leading crumbs in the jungle and making sure that we can find and save the princess. No, I don't think the institutions are doing that, Boba. What I think the institutions are doing is they have a ton of money and they have to leave the footprint over time. Like, I don't, all things being relatively equal, the institutions wouldn't want to tell us anything, like anything. All things being relatively equal, the institutions don't want anything to do with us. They don't want to show us anything. They don't want to tell us anything. Wall Street's not our friends, guys. They're not. They're our competition. And so they don't want to tell us anything, but they leave clues because they have so much of it that those volume spikes just leave that clue. And so it's kind of like that big old elephant going through the jungle. It's going to knock down some branches, buddy, and I'm going to be able to track those branches. I'm going to be able to track those footprints. Whereas if we're a monkey, for example, I'd rather call us a monkey. So if we're a monkey, we're going to fly through those swinging on branches. We're not going to leave as many clues. Does that make sense? I'm not sure the analogy did, but I kind of liked it anyways. And so they're not leaving us clues on purpose, not on purpose, but because they leave their footprint, they're so big, they're so loud, they're so noisy, it's hard not to see kind of type thing. All right, so Wall Street's those elephants, buying is a process, flies are the retail, buying is an event. Now, what happens with volume over time is volume will go to strengthen the trend over time. And so there's specific volume requirements that you look for on specific patterns, and we'll get into that here in just one second. But when you're looking at how those elephants accumulate over time, they do it through a process. And they will do it through a certain process in certain technical environments. For example, oftentimes what creates the buying opportunity at the low point is an institution came in and started gobbling up price at the low point. And then they will add to that position at key levels over time. And as you can see, as that market at support, spike in volume, market trying to break out, spike in volume, market breaking out, spike in volume, market breaking out, spike in volume. You see those volume spikes based on technical patterns over time. So the ultimate question is it the technical pattern that the institution is trading, or is the institution just simply allocating over time that creates a technical pattern? It's one of those chicken and egg type things, But to me, it's the institutions that is creating the trend that you and I trade the patterns of that trend. Does that make sense, everybody? So when you see these volume spikes over time, it gives you confidence that that trend has a consistency to it. And it gives you confidence so that you know you have backing behind the move to a certain extent. Now, on the distribution side of it, guys, it works the same way. In a downtrend, you're going to see these spikes in volume. And as you see spikes in volume in the downtrend, you start to see them as a continuation of the previous trend. And that's going to continue until it doesn't. And when it doesn't, we start to see the opposite impact. Volume gets low, 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 low. And why would I wait for volume to start getting lower? Because that means everybody's already ran its course. And so when you see these volume spikes within a trend, if you're in a bullish uptrend, you see that through the accumulation phase of institutional buying. And when you see those volume spikes in a downtrend, we're not talking an intraday downtrend here, guys. We're talking a daily downtrend here, meaning you're looking at 6 weeks of data here, not 6 minutes of data. Each one of these candles here represents 1 day of price action. You're seeing the continuation of the trend over time. And as the institution stops distributing, what will we start to see? We will start to see momentum shifts on the trend, and we will start to see volume contract. And when volume starts to contract, as you're starting to see down here, all of a sudden, you're now starting to think that this trend, which was driven through those volume spikes, you're now starting to see it consolidate down here. And so once the volume spikes start to kind of get reduced, it's kind of like, well, that institution is done dumping. Warren Buffett is done dumping Apple. Now it's time to go look at something else. I'm looking at it right here. Do you see that large volume spike at the very end? I wouldn't take that one as institution because we see that all the time. So the one thing I would say on volume on the intraday side, and that's a good question. I'm looking at your chart right now, is you're always going to see spikes in volume at the cash open, and you're always going to see spikes in volume at the end. And so you're going to want to kind of discount those very large spikes at the very open and those very large spikes at the end, because those are a little bit more kind of how the market functions at the open and at the close. The where I see the institutional kind of that first institutional buy is on that second. And let me kind of go in on the ES. Is that the ES or is that the NQ here? That's the NQ. So let's go look at the NQ very quickly here so we can see it here as a team together. And you're looking at that. We'll kind of look at it on a 15-minute chart here. So the question was, where is institutional buying? Well, number one, on the intraday side of the equation, I really don't see it as institutional buying versus institutional selling on an intraday side of the equation. On the intraday side of the equation, it's more increase, decrease in volume based on technical patterns. And so I wouldn't say this candle here on the large volume spike here was institutional buying because that's a cash open candle. And on the cash open, you got all that overnight action that's getting priced in at the very open of the market. And so I really don't think about volume on the intraday side of the equation as institutional accumulation or institutional distribution, because an institution is not going to do that on an intraday side of the equation. They're going to either accumulate and build into a position on the daily chart, or they're going to distribute on the daily chart, because it does take time. On the volume profile, and that's what I want to talk about here on the intraday, because it's not really about all I was saying is it's not really about institutional versus non-institutional when we're talking about the cash open and the market close. But from a pure volume perspective, do you see these three candles here, right here? This is the cash open candle right here. Okay, this little spike here. Here's the 30 minutes right there in between. So this is the first 30 minutes of the market right here. Now, this is the breakout channel right there, 2315. And so it's not shocking to see the battle here. And do you see how you got that large spikes in volume here as you're battling on these two candles at that key level of resistance? Now, what's creating that large spike in volume is there is a battle between the buyers and the sellers here. The buyers know if they win this fight, they have a real good chance to push the edge today. Because when you look at this breakout, there's really nothing on top until you work up into this level right here. That's a decent pocket. And so the bulls are going to fight for that. The bears are going to fight for that. You have this constant battle. It's an eternal battle between buyers and sellers. Now, do you see the volume here, how it spikes here? And then look at this volume candle here on the official breakout. All of that tells you you have higher participation. Now, what's important is you have higher participation if we confirm the breakout candle, which is right here. That gives you great confidence that the market's going to continue to go up. You know there was a battle here. You know it got confirmed right there. And right here, you know that's going back up. And so it's really the battle. The volume's telling you there's a battle ensuing at a key level of resistance. Buyers are stepping in, sellers are stepping in. Who's going to win that battle? We're going to see the other one retreat. Confirmation close here. Buyers won the battle. Game over. The war's never over, but the battle was won. And because the battle was won, what did the bears do? It doesn't matter what the volume happened afterwards. What did the bears do? They retreated all day long. What did the buyers do? Press the edge. That battle, that early battle, that 30-minute battle that we saw early in the market, once it got confirmed right there, you know you got a move coming because those bears are going to retreat. And what creates a lot of the momentum coming out of those battles is bears have to buy their short to close it. That creates a participation trophy in the market, will give it, and it creates a little bit of a momentum condition. Does that make sense? I swear to the altar of the 9 EMA on the 15-minute chart, the 1 hour chart, and the daily chart, and the weekly chart. It is my end-all be-all decision-making momentum support level. I said last week, guys, if you want to capture more of a trend, start anchoring against the 9 EMA as a stop loss and let that momentum play out. Big believer in it, ladies and gentlemen. I saw a couple different times this week where that philosophy of riding that 9 EMA, where you can really helped out this week a couple different times, I would say. Oh yeah. I'm bent knee bowing to the altar of the 9 EMA. It's my end all be all. There's no doubt about that. But I thought that was a great question, so I just wanted to kind of take it into that. Now, when it comes to volume, guys, like I've said many times, I navigate the technical conversation of every asset class on every time frame through the 1, 2, 3 philosophy. 1 is breakouts, 2 is extension, 3 are pullbacks. There's fractional patterns obviously there, but that's how I navigate the financial world. Is I see it through the 1, 2, 3. Are we at 1? Are we at 2? Are we at 3? What does that tell me I need? What does that tell me I need to wait for? We've talked about this slide many times. I love teaching off this slide because it gives you that understanding. When it comes to volume, what you want to see, like best case textbook example on volume, what you want to see when you're going into a breakout is increasing participation. You want to see institution and us all simultaneously seeing the same thing, triggering on the same thing, creating a momentum condition. If we have low volume on the breakout, that's a warning sign, guys. And so if you don't see increasing participation when the candle is attempting to break out, that's often signs that you're not going to see momentum. And if you're not thinking momentum on a breakout, you shouldn't trade the breakout, because breakouts are momentum based patterns. You want to see momentum going into them. You want to see momentum on top of them, and to create that type of momentum, you want to see increasing participation. So the rule of thumb on any breakout, it could be breakout out of neutrality, it could be breakout out of a continuation pattern, it could be a breakout out of, within an existing bullish uptrend. It doesn't matter what it's breaking out of. Any breakout, reversal breakout, continuation breakout, trending breakout, you name it. Break resistance. Don't care the time frame. Don't care the pattern. You need to see a spike in volume, because that spike in volume tells you there's legs here. There's momentum here. And this thing is not just you, me, and some random dude in Ohio. This has some backing behind it. And because of that, we feel we can catch some momentum there. Now, as the market goes up, 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 obviously this can't continue to go up. So as you get into the overextended, I call myself random every now and then, Gabber. As you get overextended, we're all ones and zeros when it comes to the market, ladies and gentlemen. But when it gets up into the top end of the market, there's a couple things that typically you'll see here. Do you remember yesterday we were sitting in the in Power Hour? Mike was hanging out and he was talking about how he could see another leg up basically, but he wasn't expecting a ton. He just was expecting another leg up, and then we might go through some bearishness type thing. Well, as the market is going up, 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 one of the things that we can see up here to indicate that that's exhaustion is, what do you think we're going to start to see on volume up at the top? What do you guys think? High volume, low volume, to give me an indication that that moves over. What do you guys think? High volume or low volume? Typically it's low. Typically it's low. Typically it's low. Um, every now and then though, you will get a very high volume spike, but with a doji candle. Now, regardless of the spike in volume or not, okay, if you get a spike in volume but a slowing momentum candle, Raven's right. That is a massive sign of divergence. A massive warning sign, guys. A massive, 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 massive warning sign. When you get a spike in volume, but slowing momentum on the candle. So a smaller candle, but a spike in volume, that is a sign where it's not just profit taking coming to you. Because what the low volume environment tells us is it's bull on bull crime. I want everybody to write that down. Bull on bull crime. Everybody write that down. I'll write it down too. Bull on bull crime. Guys, that's all we want to see here. Bull on bull crime. Everybody write that down. It's very important. Everybody write it down. Bull on bull crime. Not prime, crime. We're not ready to watch Prime Video yet there, Blazo, though if you got a good suggestion, I'm open. I'm open. I watched a terrible sci-fi movie last night. Terrible. Terrible. And I'm a big sci-fi guy. The reason I say bull on bull, guys, is if you see a spike on volume, doesn't that tell us that there's more than just bulls up there? Like if you see a spike in volume at the high price, doesn't that tell us there's more than just the bulls up there? That the bears are getting aggressive? And I don't want to see that at all. I want to see low volume environments. And as the market starts pulling back, I want to see the continuation of the low volume environment. Because what the low volume environment tells us as the market is pulling back is it tells us that the bulls that made this money on the top side are simply locking in profit on the downside. That's all it tells us. So those bulls are pushing the price up, 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 up. You start to see the low volume environment here. That's indication that this momentum is over and we're going to start this pullback. And if the pullback's going to be clean, consistent, and something I want to trade, it's going to be a bull on bull environment where the money where the market is simply locking in profit on this down pressure in price because the traders are simply locking in what they made in the upward movement in price, creating that 50% Fibonacci retracement, basically. And so as the market is breaking out, we want to see the expansion of volume. As the market gets overextended into pattern number 2, we want to see the volume contract. And as the market is pulling back in the bullish retracement, we want to see light volume. So when we're breaking out here, do we want to see big or light volume? When we're breaking out, do we want to see increase or decrease? What do you guys think? Pop quiz. Increase or decrease volume on breakout? We want to see an increase. Now, as it gets overextended, what's the warning sign that the move's starting to get exhausted? What's the warning sign on volume? Lower volume. Okay. Now, we want to see that lower volume continue in the pullback, correct? We want to see that low volume environment continue in the pullback. And then when we get that upward movement in price, the IE confirmation candle, big volume. Okay. So pattern number 1, big volume. Pattern number 2, light volume. Pattern number 3, big volume. 1, 2, 3. 1, breakout, big volume. 2, extension, light volume. Retracement, which is part of 2, light volume. Confirmation on the pullback, big volume. We want to see participation that couples with our confirmation candles. Does that make sense, everybody? So 1 big increase, 2 light, 3 big. Now, when you look at it through the breakout lens, take Taiwan Semiconductor today, for example. Right here, we have a known resistance level. Okay. Going in to the resistance test here and here, we have 2 spikes in volume. Now, today is the breakout day. We are breaking out of that level of resistance right here. So we're breaking out officially, and we have a spike in volume. What does that tell me? Just this candle coupled with that volume spike, what does it tell me about the future of price? What should price do over time? We have a breakout on high volume. Well, let me ask it like this too, while you guys bring it. Okay. Continuation is the answer. Okay. Continuation is the answer. Who created the big, well, let's come into the market and see it here too. We'll come back to here in a second. Okay. Taiwan Semiconductor. Daily chart. And again, I do not want you guys to think like day traders here. I want you to think like trend traders. Okay. Now, bullish uptrend, continuation pattern, breakout, massive spike in volume. Now, on a breakout, we want to see an increase in volume. No doubt about that. Number 2, who has the type of money to push 27 million shares of a $240 company in one day? Is it retail or is it institution? It's just institutions. So were those institutions buying today to sell tomorrow? That's not how they think, right? That's not how they think. So am I going to see the volume spike as a positive or a negative thing today for Taiwan Semiconductor? I'm going to see it as a positive. Okay. Now, does that mean I run out to the market today and just go buy as many Taiwan Semiconductor shares as I possibly can? No, no. What it tells me is that we have a trending condition. And if I get the pattern I want, I have confidence to trade that and hold it in a trending condition because I got my volume spike. I took this screenshot earlier today. You saw obviously what the volume spike did. And so when you're looking for a breakout, you want to see that big volume spike. Now, we got a volume spike today because of earnings. That's why we got the volume spike. But the causation for why the volume spike is not really that important. What's important is we got the volume spike and a confirmation close above resistance. That is confirmation on a breakout. Does it automatically mean Taiwan Semiconductor is going to go to the moon over the next 3 months? No. What it means is you have an edge in the trend, is what it means. It means day traders, swing traders, position traders alike are all looking simultaneously at that same environment. And unless the variables of the environment change, all things being relatively equal, we should see further upward movement in price on Taiwan Semiconductor. That's what it means. And when we get that clean breakout, which we have on Taiwan, with both volume and momentum, you have a really good situation from a trending situation happening. And so when you deal with volume, and I thought the Dow Jones today, this is a chart of the Dow Jones today, by the way. I thought the Dow Jones was very telling from a volume perspective today. Now, what you're seeing here is a pattern called the cup and handle formation. Here's the cup right there. Here's the handle. Here's the breakout. Cup, handle, breakout. Cup and handle breakouts are continuation breakouts that are the beginning point of a trending analysis. This would be an intraday trend because we're looking at it on a 5-minute chart, obviously. The reason I pulled up this screenshot today is I felt it showed a very, very compelling volume or understanding of volume. For example, as the market is pulling back here, what do we want to see in a pullback? Higher or lower volume? What do we want to see in a pullback? Higher or lower volume? We want to see lower volume. Well, as the market is pulling back here, do we have lower volume? Yeah. Basically, everybody in the dog is saying, I don't want to have an opinion yet. And if everybody and their dog in the market is saying, I don't want to have an opinion yet, should you have a strong opinion? If everybody in the market is saying, I don't have an opinion, should you have an opinion? You can have an opinion. It just shouldn't be one with conviction because you don't have that yet. And so as the market is starting to turn and confirm, this is a confirmation candle right there. You get above the noise here. Now, as the market confirms, do we see a spike in volume right here as the market is going back up? Do you see how volume starts to spike above the average? The yellow line is the 20-period moving average on volume. So it's measuring the last 20 bars here. And so do you see how we got that spike in volume right here? Well, look at the market here. Market goes right back up. And so while the market was pulling back and then consolidating, it was all low vol. Low vol. Shouldn't have been too aggressive. Market spikes back up, confirms right there. Now we get that move back up into the resistance level. And so as the pullback was happening, we had low vol. As the pullback was consolidating, we had low vol. As the pullback was therefore confirmed, we saw an increase in volume. That's volume confirming the cup and handle and the pullback. And then what I found very interesting here today, I didn't take this trade on the Dow, but I did on the ES. You see how it just kind of consolidates right here underneath that, this was earlier this morning high. So it consolidates right underneath that resistance level. Now, as the market is breaking out here, you see how the market breaks out of that base right here on this candle. And then this candle breaks through the entire range. And so you have this candle right here, which is a breakout candle of this high base. And then you have this candle, which is the breakout of the entire range. Now, on these two candles right here, do we have a spike in volume? Yes or no? So we have that spike in volume on the breakout. What should we think when we have a spike in volume going into the breakout? I have a good situation. I have a breakout that I have confidence in. It's breaking out of a clean level of resistance. We have additional participation. There's nothing else to think about. Either make the trade or don't, but don't think about it. You have everything you need to have. You had the pullback get confirmed on the increase in volume. You had the breakout get confirmed on the increase in volume. And when we come back out to the Dow Jones here today, YM, let's kind of go into the intraday side of the equation here. Let's look at that 5-minute chart. You see that cup and handle here, guys? See the breakout? And then that movement happens on the top side. Now, we're pretty much done here, right? I wouldn't worry about that. That was a mishit, honestly. But when you, oh, excuse me. Or there it is. Okay. Oh, back to the here. Now, do you see the Dow Jones here? See this beautiful cup and handle? Beautiful breakout there. Now, it got a little bit of momentum, but then the market just kind of did nothing. But does that set up the Asian markets tonight? What do you guys think? Does the analysis from the cup and handle Dow Jones earlier today and the confirmation on that volume breakout today, does it set up a potential breakout later on tonight? Or even tomorrow, coming into the futures tomorrow? Yes. And so it was kind of late stage in the market, but that was a pretty good little confirmation candle on that as well. We already talked about overextension in that situation. Now, guys, oh, I just did that. Hold on. There we go. So what I wanted to do here today, guys, is I wanted to have a conversation over volume. And I wanted to do it from a definitional perspective so that we could all have the same understanding of volume from a pattern perspective. What creates the volume, how to read it, what it measures, why it's important, and then take a look at it through the different lens of different technical patterns. Did you guys enjoy the lab today? Was it helpful today? Awesome. Now, when we do these types of definitional labs, I do it so that we all have an understanding, so that as we have back testing conversations next week and the week after that, we can start using this in our toolbox. That's what learning all these techniques is all about technically, guys. It's just adding another tool to our ability to navigate the market from a technical perspective. And so I'm very happy you guys enjoyed it. Secondarily, what do you guys want to work on next week? I'm in the mood to create another beautiful presentation for us. So, what do you guys want to work on next week? Let's throw it out. Let's have an open conversation. What is something that you could use more help on? We'll definitely do more on volume. I love psychology. And I still think we need to do a conversation on prospect theory. I definitely still believe we need to do a conversation on prospect theory. Prospect theory can be applicable to your current trading, and it's heavy on mindset. If we're ever going to do mindset, I think it's got to be applicable to the trading side of it as well. But I like that conversation. More on volume. We could always do more on volume. I could talk about volume till the cows come home. I would give that some thought. Let me give that some thought. And obviously, if you guys have any pressing ones, just hit me up in Discord as well. Um, all right, I'll think about that one. Pullbacks, how to navigate pullbacks, putting it all together from step one to step six on pullbacks. Do you guys just want to laser focus on pullbacks? Raven, I love the divergence conversation, volume and divergence, indicators and divergence. Absolutely. I enjoy a good divergence conversation. Uh, let's do divergence in a couple weeks, though. I'm more than happy, Raven, to do more on divergence. I would ask that you go and review some of the indicator ones we did on YouTube. Every one we record here, guys, we post on our YouTube channel and then we put it in Discord. And I've done divergence on indicators, not specifically volume, but one of those divergences would be the crazy spike in volume. That is never a good thing in pullbacks. Do you see how the ES is pulling back here and get this crazy spike in volume here? Not shocking that you see this down the road. Like that's a divergent conversation. The volume is doing something divergent than what you typically need to see. That leads to a counter trend of volatility. So divergence is always going to be an important conversation. I'll give it some thought. Uh, Order flow is always a good one. Order flow is always a deep dive. These are good suggestions, guys. I'll give it some thought. I think next week, I kind of like where Think and Grow is at. Kind of just really mastering the pullback from a candle price, Fibonacci, moving average, confirmation, indicators, you name it. Just laser focus on pullback analysis. And obviously, I could mix in some of these other conversations into that one as well, volume, other metrics as well. I think that's what we're going to do for next week. I'll do a deep dive into pullback analysis and fit indicators, volume metrics, and whatnot in that conversation. How does that sound, guys? APG, that's a great question. What time frame is best? First of all, on the 1, 2, 3 volume metrics, so one breakouts, two extension, three pullbacks, regards to the time frame, if you're trading a breakout, you're always going to want to see an increase in volume. When you're trading a retracement, regardless of the time frame, you're always going to want to see a decrease in volume. And confirmation in a retracement, you're always going to want to see a slight spike in volume. That does not matter if you're a scalper trading a 2-minute time frame or a position trader trading a daily, weekly time frame. I think what where volume becomes important from the institutional side is the daily chart. I think the daily chart is probably a little bit better to understand the entire story of volume. Is to me, I like to look at that on the daily time frame. And so if I'm trying to understand the institutional side of it, the trending side of it, that's a lot of daily stuff for me. I don't think you can see that on weekly charts nearly as well. And on the intraday charts, you get a lot of open versus closed nonsense. And so I think the best time frame for to understand the story of volume is the daily time frame. But on any time frame, you can understand how what you need to see on a breakout with volume, or what you need to see on a pullback with volume, or what you need to see when you're looking at about a confirmation with volume as well. And so I would say the daily time frame. 100%. That's great. All right, ladies and gentlemen. With that said, we're doing pullback analysis, deep dive into pullbacks next week. We're mastering the pullback next week. That's what we're going to work on. And I need everybody to do me a favor, okay? Tell somebody in BluSky how awesome this lab is so we can bring more and more and more people to this lab. Can everybody do that? Our goal is to bring one additional person to everybody. Everybody good with that? I love this lab. I love this lab. I just want to see 50 people in this lab. Think we posted on the BluSky YouTube channel. We don't heavily promote the BluSky YouTube channel, but I think we'll do more with these type of streams. But yeah, we do post it on the BluSky, and I think I'll have Makaram put together a playlist for all these because I don't think they're in a playlist right now, and we've done a ton, so I think it deserves a playlist. And so I'll talk to him about putting them all in a playlist, so that people can understand what topics we did. But yeah, we do post it on YouTube. Thanks, Bubba. You have a great day as well. All right. Happy birthday to Ned Divine as well. There you go. Yeah, playlisters too. It's time to put it on a playlist. Thank you, F. And always, if you watch Coach Bench streams posted on YouTube, you have to watch for at least 3 minutes, and you have to hit the like, and you have to put a comment. That helps us get more visibility for that. Appreciate you guys. Tomorrow I'll hop in and out when I can. I usually can't get there for happy hour, i.e., power hour, when it comes to Fridays. I do a lot of writing on Fridays. But if you need me for anything, guys, hit me up in Discord. Outside of that, I hope everybody has a wonderful, wonderful rest of your day. Thanks, everybody.